European stocks approach new highs, and commodities are up after positive Chinese manufacturing data. However, fiscal cliff talk uncertainty remains as we head into the first week of December. I'm Nicole Urken, and the morning call starts right now.
Good morning, I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Nicole Urken with The Street, and together we bring you the Morning Call Express. Now, Scott, over the weekend there were continuing fiscal cliff headlines everywhere, all the talk shows, all the newspapers and beyond.
Think?
Yeah. But, the market this morning seems to be digesting some of this still uncertainty pretty well. We've seen some support for the rally at the end of last week that started over Thanksgiving period. Are people kind of apathetic now? Are all of the worries priced in?
I think people have like a callus now to fiscal cliff. They're almost fiscal cliffed out. So it's not affecting the market the way it did 2 weeks ago. So to me, I think, overall the market's acting much more constructive. If you take a quick look at the chart here of the S&P, you will see, very important inflection day. I'm sorry that I keep beating a horse about it, but this was a very important day. This was the outside day. Then you had nice follow through. We held higher, continued last week when we were on. We talked about healthy digestion in the market. We wound up holding higher. They shook the tree a little bit right here, but we came right back to close strong. And here we are, ready to take out the 50-day moving average. So I think traders are going to see how we close. Do we push through the 50-day and fail? Do we close above it? And if we do, next real area is about 1434 in the S&P.
Yeah, we've seen, like you mentioned, some really positive action from the market as a whole, but we've also seen some good moves from individual names, some of the tech sector in particular, some of the big tradable names like Google and Apple, which you always talk about. So what do you think of these names here? They've had quite a nice bounce.
Well, you want to manage positions, and right now I do think there's more upside, but it's not a place to go all in. If we go over Apple first, you will see, look at the chart here. It's been unbelievable ever since that red dog reversal right there. We talked about an entry around 522. You had a quick move, consolidated well, gave you another entry above this, 572, and then it went sideways for a little while, a little choppier, but I do still think there's more upside if it could finally get up and close above this 594. 50 days in front of it, but I don't see any reason why we can't see 610 to 620 before we get bigger resistance. And we talked about last week, Google, wow, talk about timing a move. It was showing relative strength around 660 and then it busted through. Next resistance there is around 705.
So we've seen some really positive action into important names. Like you've mentioned before, these are the heartbeat of the market. So definitely a nice sign there. But as we think about individual names, one sector that's been a dog of late has been the quick serve restaurants. And on last week we heard from Yum Restaurants, which has been really a winner all along, and it reported a pretty disappointing 2013 outlook, disappointing Q4 comps in China in particular. For this, it's been a big driver of the group. What do you say to Yum? Are you worried?
I say that they sandbagged a lot of people because it looked like last quarter was great. They gave normal guidance. Stock was on the high. So for them to come out and say that, I think a lot of investors were taken by surprise. If you go to YUM and look at the chart here, it was near the highs, acting well, a chosen one, and pow. That right there is not a good situation. I think at this point people are going to put it in the penalty box. If you weren't involved in it, I guess, get a few days to develop here and then we'll see how it handles this gap. If it doesn't fill this gap or a big portion of it in the next week or two, you'll know that the stock's going lower.
Yeah, it's certainly tough to be the chosen one because after that point you have to really keep exceeding expectations. But look out for the Analyst Day this coming Thursday. We'll be hearing more from Yum and might give you some more information to make an informed decision about what you want to do going into the end of the year and then 2013. And then, of course, we have the quick serve behemoth McDonald's, which has really been a laggard this year. Great exposure to Europe, disappointing comps, particularly last quarter negative for the first time since 2003. Unheard of for McDonald's. So, here, though, the valuation looks interesting, not really a catalyst right now. What do you think of the chart?
I think a lot of people have been avoiding it. A lot of people have wanted to get involved in McDonald's because of the history. It's acted really well, and you haven't been in bad shape buying a big dip in McDonald's, and this one has continued. If you look at the chart here at McDonald's, you will see, you go into a macro chart, it's behaved really poorly, okay? Just a big downtrend. I'm not going to get into it, but down here, like you said, value people will probably look for value. Technically, I do like the way it's acting. It's acting a little bit better. Market was, sort of flat. It was up nicely on Friday or tried to be strong. So above this area, 87.31, Next realistic spot is the 88, 93, and then who knows, maybe into the first quarter tries to fill a portion of this gap to 91. So at this point, if you're not at McDonald's, it's definitely something you could fundamentally go into a tier 1, and it does look like it's acting a bit better.
Yeah, these kinds of moves make the market interesting. And another big name that you haven't really lost money in buying on dips over the long term is Disney. Separate from this restaurant sector, we've talked about M&A kind of picking up toward the end of the year. Disney recently bought Lucasfilms, was down after its latest quarter. Very quickly, what do you think here?
I think that I like the fact that it filled its gap, so it showed demand on the weakness. I think, again, Disney's something, if you have a plan and you want to buy dips in it, it probably makes sense because you don't get that much momentum in this name. So if you look real quickly at the chart, you'll see it did bounce off the moving average. It did fill a portion of this gap. So I would say a little bit of work above 49, and it can continue at something, might not be a barn burner, but if you want to buy the dip there, in the past, you've been rewarded for that.
Right, long term versus short term. Well, we're going to get into all of these names and many more on the long form, so stick around.
Hi, I'm Sean Hendelman of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.